Hello, ladies and gentlemen, Greg McCloskey from ForexLive.com. This is a Kickstart video. In the Kickstart video, I take a look at three of the major currency pairs: the euro versus US dollar, dollar versus yen, sterling versus US dollar from a technical perspective. I'm going to gloss over those a little bit this morning, and also take a look at the dollar versus Canada. We just had an employment data come out in Canada. Came out kind of mixed, so not we don't have a lot of movement, it seems, in the currency pair, but it's worth a look. So let's get started. All right, let's start by taking a look at the dollar versus Canada, and we did have the unemployment rate tick down to 6.5%. They're expecting 6.6%. Actually, it remained the same. The employment change was a little bit lower at 14.5% versus, or 14.5 thousand versus 25,000. Full-time employment advanced by 25,000. Part-time declined by 11,000. So, there's some good and bad in there, but it's kind of sluggish overall. And that has the dollar versus Canada, after dipping it initially a little in after the report, moved back to the upside. We are in my pre-technical report this morning. I said, as long as the price can remain above the 100 and 200 hour moving average, I think the bias remains more to the upside here, with lower Canadian dollar, higher US dollar, and that's what's happened so far. So watch these levels right here. The 200-hour moving average comes in at 1.39037. The 100-hour moving average comes in at 1.38912. Staying above that, given the break today, would keep the buyers happiest. If we do move below that, it could disappoint the buyers and have traders looking back down toward the 100-bar moving average on the 4-hour chart. That level comes in at 1.3868. Break below that level, then we start to look toward this swing area, which found support in trading yesterday. So those are the levels, but right now the buyers are more in control. Let's take a look at the euro versus US dollar next, and I'm going to focus on the hourly chart for this currency pair. And look, we're breaking down below the target floor here, or this target support level here. Defined by these levels right through here, traded above and below it through the employment, or this is the election day, I should say, and then came up to the level here, and then started to find support against this level late yesterday and again today. The break below that level increases the bearish bias here in the euro versus US dollar. We are with the things like Trump tariffs expected going ahead, that's not going to be good for other countries, I would expect, so there, fundamentally, is probably a bearish bias for the euro and for other currencies in general, and a bullish bias for the U.S. dollar. You would think. Nevertheless, we're going to pay attention to this swing area right here between 1.07609 and 1.0776. As long as the price can remain below that level, that's the best case scenario for traders in the short term, and we can hope to move down toward the low price that we saw earlier this week at 1.06819. Just take a look at the 4-hour chart. That low price that we saw this week got within about 12 pips of the high of this triple bottom down through here, which happened in June, and these 3 consecutive weeks here came with support down near the 1.0665 to 1.0670. So we're up here at 1.0745, so a bit of a ways to that level, but be aware that triple bottom exists down there and remains a key magnet for the euro versus US dollar if we continue the downward bias in that currency pair. Let's take a look at the sterling versus US dollar. We've seen a lot of up and down price action in this currency pair over the last few weeks of trading. I put a red box around it here. In trading on the election day, we did move below the low of this area right through here, and quickly failed, and that helped to push the price higher, at least technically. Of course, we continued that move to the upside, and in the process, we moved above this cluster of moving averages. The moving averages, including the 100-hour moving average, the 200-hour moving average, the 100-bar moving average on the 4-hour chart, and up here, the 100-day moving average. By the way, the 200-day moving average is down here at 1.28152. So be aware of that going forward. We did, once again, find support buyers ahead of that level earlier this week. So this area right here is going to be the bias for the short term, and for short term in this pair. If we were to move above it, it would be more bullish, and we move toward the high of the extreme. As long as we stay below it, it's more bearish. The other level of interest here, which I outlined in my morning report, is around this 38 level. If I put a thicker line through here, you can kind of see how, support, resistance, support, resistance, bullish here, bearish here, break above it here, support. It has a place in my heart, so I may include that within this yellow area right through here as the bias defining level on the downside. If we break below it, if we stay below that level now, that would increase the bearish bias. Half traders looking toward the low and then looking toward the 200-day moving average. Don't forget about that on the downside. Finally, let's take a look at the dollar versus yen, and looking at this currency pair off the hourly chart. The price action and trading yesterday came down to these converged 100 and 200-hour moving averages. We actually broke through it toward the end of the day, tilting the bias more to the downside, but moved back above it in the Asian session, and we came back up to the 61.8% retracement. I'll show where that comes from in just a second, but the sellers leaned against that 61.8% retracement and pushed that back down below these converged moving averages, and you can see how the corrective high right here did stall against that level, giving the sellers the bias tilt. Down here we do have support here, including the 200-day moving average at 151.669. The price is going to need to get below that 200-day moving average. We held support against here. We held support against here. We held support against it here. Held support against it here in trading on the I guess Tuesday. Today we fell below that level and then moved back above it here, increasing the bullish bias through the election. So getting to and through the 100-day moving average is going to be key for sellers of the US dollar. If it can't get below that level and we start to move back above the 100 and 200-hour moving average, that would be more bullish. I promise I take a look at the 61.8% retracement. You need to see that off of the 4-hour chart. And if I go back to this high right here, this is the high price going back to July, to the low price that we saw in the month of September. The 61.8% retracement is at 153.397 level. So get above that level increases the bullish bias. By the way, the high price that we saw in trading this week came up to this swing area through here, where we had a number of different swing lows and highs going back to this area right through here. So it was a nice level to stall the rally in trading this week. So there you have it. Look at the three of the major currencies pairs, plus a bonus look at the dollar versus Canada. My name is Greg McCloskey. Good fortune with your trading today. Bye-bye.